Um, Imagine a country with like practically zero natural resources, no vast oil fields hidden under the soil.
Right, no massive veins of precious metals or anything like this.
Exactly. No deep water ports to launch massive cargo ships either. In fact, it is entirely landlocked, boxed in by some of the most, historically aggressive and dominant military powers in European history.
Yeah, historically speaking, that's a pretty terrible hand of cards.
It really is. By all traditional laws of geography and historical economics, a place like this should be, at best, a modest agrarian buffer state. It certainly shouldn't be wealthy.
No, I mean, it's a geographic setup that usually guarantees a country a permanent spot in the, middle to lower tiers of the global economic hierarchy. You're entirely at the mercy of your neighbors' toll roads and, well, their trade moves.
And yet this country engineered an economic reality that completely shatters that geographic logic. We're talking about an economy boasting a per capita GDP of over $90,000.
Wow.
Yeah. We're looking at a population where life expectancies are steadily pushing toward 86 years old, and a governance model that ranks at the absolute mathematical peak of global efficiency.
It's honestly wild.
It is. And today, for you listening, we are doing something totally unique. We haven't been handed a standard, sprawling, 400-page economic textbook filled with historical noise. We've been given access to this highly curated, minimalist academic presentation deck.
Yeah, and the massive underlying database of World Bank indicators that backs it all up.
Exactly. And the visual instructions for this data set alone, I mean, they tell you almost everything you need to know about the psychological mindset we're analyzing today.
Oh, totally. Like if you were standing in a room looking at this presentation, you wouldn't see any flashy 3D graphics, right?
No, none of that.
You wouldn't see decorative stock photos. The design mandate is pure, absolute minimalism. It's stark white backgrounds, literally hex code FFFFFF for the designers out there.
Right, pure white.
And just deep gray and like this dark navy text, hex 2C3E50. The only visual relief is the occasional low saturation academic blue line pointing out a critical data inflection point.
It's so clinical. So for you listening, picture the auditory equivalent of that space. You're not in a bustling, chaotic stock exchange. You're standing in a completely dust-free, climate-controlled, high-tech research facility, like buried deep inside a granite mountain.
Just the quiet hum of secure servers.
Yeah. Because every single data point we are going to explore today has been stripped down to its absolute essence and rigorously justified. And our mission today, well, okay, let's unpack this. We need to figure out exactly how Switzerland pulled off this socioeconomic miracle from 1960 to 2023.
And maybe more importantly, we need to uncover the hidden structural cracks in their seemingly flawless design.
Yes. Because there are cracks.
Oh, definitely. I mean, any system tensioned this perfectly, operating at this level of elite efficiency, it becomes hypersensitive to underlying shifts. Like a single demographic flaw can threaten the integrity of the entire architecture. But to understand those vulnerabilities, we first have to, look at the sheer scale of the machine itself.
Right. Let's unpack the macro level first, because before we can even theorize about how the Swiss model operates, the raw output is just staggering. If you look at slide 3, the long-term area charts for per capita GDP, which, by the way, is measured in constant 2015 US dollars.
Which is a crucial detail.
Extremely. Because this isn't just inflation artificially pumping up the numbers. It's a masterpiece of relentless upward momentum.
Yeah, that constant dollars part is vital. When we see the data marker starting at roughly $39,900 back in the early decades.
Which was already incredibly wealthy for the era, by the way.
Exactly. And then smoothly climbing to cross the $90,000 threshold recently, we are looking at real, tangible expansions in purchasing power. It's actual value creation per citizen. It's not some currency trick, it's a productivity reality.
But, the part of this macroeconomic timeline that makes me stop and stare are the data points around the years 2009 and 2020.
Ah, the shock absorbers.
Yeah. Because I've looked at the economic charts for the U.S., the U.K., Germany during those years. The global financial crisis and the COVID-19 pandemic usually look like, well, cliff faces. The line hits a wall and just drops into a ravine.
Total free fall.
Right. But on this Swiss data set, those global catastrophes barely register as a tremor. The designers actually mark them with these subtle dashed circles, and the line dips slightly, then immediately steepens and recovers. How does a country that connected to the global economy completely bypass a global crash?
Well, they don't bypass it, they absorb it.
Absorb it. Okay, how?
The mechanism at play here is counter-cyclical resilience. Think about what happens in a global crisis. In 2008, massive financial institutions were collapsing, right?
Yeah, everything was melting down.
And global manufacturing just ground to a halt. Countries that relied on exporting physical things like cars or consumer goods, they were devastated because demand vanished overnight.
Sure, nobody's buying a new car in 2008.
Right. Switzerland experienced a contraction, yes, but their recovery curve is exceptionally steep because their economy is structurally designed to act as a global macroeconomic safe harbor. When volatility spikes, global wealth doesn't flee the Swiss system.
It runs toward it,
Exactly, it actively seeks it out.
which points us straight to slide 4, right? The engine inside this shock absorber. You'd think, looking at a country known for luxury watches and high-end machinery, that physical manufacturing is keeping them afloat.
That's the common assumption.
But the structural data flips that assumption entirely on its head. The stacked charts here show the total value added by their service sector jumped from roughly $324 billion to over $674 billion.
It literally more than doubled.
Yeah, but it's the per capita number that breaks my brain. The data shows they're generating between $130,000 and $140,000 in value from the service sector alone per person.
It's unbelievable. I mean, to put that into perspective for you listening, there are highly developed G7 nations whose entire per capita GDP, like across all sectors combined, doesn't even reach half of what Switzerland generates purely from services.
Wow. It makes me think of like an ultra high-end magnetic suspension system on a bullet train.
Okay, I like that.
Yeah, like the train is rocketing over this incredibly bumpy, volatile track of global markets. But because the suspension, which is the service sector, is so perfectly engineered, the passengers inside don't even feel the vibration. The system absorbs the external shock and just quietly outputs hundreds of billions of dollars.
It's a great analogy, but we need to look at what those magnets are actually made of, right? Because you don't generate $140,000 of service value per citizen by, opening more coffee shops or expanding retail.
No, definitely not.
That level of output requires an economy hyper-focused on the absolute peak of the global value chain. We're talking about advanced reinsurance, literally insuring the global insurance companies against massive disasters.
The ultimate safety net.
Right. We're talking about managing the intellectual property portfolios of multinational conglomerates, specialized pharmaceutical consulting, elite corporate wealth management.
So they aren't just participating in the service economy. They are dominating the invisible high-margin architecture of global business.
Precisely. They handle the complex, high-stakes intangibles, the stuff that requires mathematical precision and absolute legal certainty. And doing that requires an infrastructure of immense, unbreakable global trust.
Okay, but this brings up a massive geographic paradox for me. If we move to slide 5, the trade data, if they are outputting hundreds of billions of dollars in these advanced intangible services, they have to be selling them to the rest of the world, right?
Right.
But Switzerland has no oceans. They have 0 deep water ports. They are completely boxed in by the Alps and massive European neighbors. If I want to export $1 billion worth of, cars, I need a fleet of massive cargo ships. How do you project this much economic power globally when you are totally landlocked?
Well, you have to realize that geography is only a limitation if your primary export has physical mass. The trade dependency data on slide 5 visualizes this pivot beautifully. Look at the dual bar chart. If we track the trajectory of their service trade as a percentage of their entire gross domestic product, the leap is extraordinary.
Yeah, the designers used this blue shadow to highlight the jump.
Yeah.
In the early 2000s, it sat at roughly 10%.
And by recent years, that number has expanded to a staggering 41.5%. Nearly half of their entire domestic output is tied to trading services across borders.
So they just bypass the mountains entirely.
Completely.
I mean, they don't need a port in Zurich to export a multi-billion-dollar reinsurance policy to Tokyo.
Yeah.
Or to provide architectural consulting to a massive infrastructure project in Dubai. The product just travels through fiber optic cables and secure servers.
Exactly. It's a doubling plus expansion of their service trade proportion. And it proves that in a digitized, heavily financialized global economy, data and trust travel at the speed of light. Physical borders become largely irrelevant to their core economic engine.
I understand the mechanics of that, but put yourself in the shoes of a business owner for a second.
Okay.
If I'm running a company and 21.5% of my revenue is entirely dependent on external clients operating in volatile markets, I would be terrified.
You'd feel exposed.
Yeah, if the rest of the world hits a recession and stops buying, my company goes under. Doesn't this massive reliance on external global demand make Switzerland incredibly vulnerable? It feels like tying yourself to the mast of a ship in a hurricane.
That is a very logical assumption, but it misunderstands the actual nature of what Switzerland is selling. Yes, mathematically they are highly exposed to global demand, but they have intentionally positioned their services not as optional luxuries, but as foundational necessities for global capital.
Okay, how so?
Think about your hurricane analogy. When the storm hits, people don't stop buying umbrellas and plywood, right?
Yeah.
Demand for protection actually skyrockets. In the global economy, Switzerland is the ultimate storm shelter.
Oh, wow. So they are selling the plywood to the global financial system.
In a sense, yeah. Their strong rule of law, their fiercely independent currency, their historical political neutrality, these aren't just cultural quirks. They are deeply calculated economic assets. They act as a massive anchor.
Makes sense.
When markets panic in London or New York or Tokyo, corporations don't cut their Swiss risk management contracts. They double down on them. That's why that 41% trade flow doesn't evaporate during a crisis. They are selling stability in an inherently unstable world.
That completely reframes the entire picture for me. They've essentially monetized institutional trust.
Exactly.
But to maintain that level of trust, to output the most elite, complex services in the world, you can't just rely on good laws. You need people who can actually do the math, write the code, and manage the risk. If your only real resource is your population, you have to optimize human beings to a degree that almost sounds like science fiction.
Which brings us to slide 7 and the absolute foundation of the Swiss model. The human capital fortress. Because if you're going to run a high-margin service economy, your workforce cannot be bogged down by basic survival struggles. You have to eliminate the foundational friction of human existence as much as possible.
And the health metrics in this data set illustrate that elimination of friction perfectly.
Yes.
I was looking at this smooth descending line chart tracking infant mortality trends, and it's almost hard to comprehend the scale of the improvement.
It's steep.
Back in the 1960s, the rate was around 21.7 per 1,000 live births. Today, it has plummeted to roughly 3.5. And they've got this little gray circle marking the tail end of the curve for maternal mortality, sitting at around 5 per 100,000 live births.
Right. And when you look closely at that maternal mortality figure, it is essentially brushing up against the natural biological limit of human medical intervention. You're looking at a society that has constructed the ultimate public health floor. By practically eradicating these fundamental tragic health risks, they guarantee that nearly every single citizen born has the physical opportunity to enter the economic machine.
And once they enter it, the data on slide 6 shows they stay active and productive for an incredibly long time. The longevity boom is wild. They use this dual-axis line chart, right? Women have gone from a life expectancy of 74 years all the way up to pushing 86 years old.
And men have climbed from 69 to nearly 82.
And they have these little dashed extension lines pointing toward 85 plus. But I want to explore the why behind this. Because it's not just about having good hospitals, is it? How does knowing you will likely live a healthy life into your mid-80s change the actual psychology and economic behavior of a society?
Well, it fundamentally rewires the societal incentive structure.
How so?
If the average citizen is going to live and work into their 80s, the concept of a return on investment completely changes. When a government or even a family knows a child has an 85-year runway, spending massive amounts of capital and time on their education isn't a gamble. It's a guaranteed high-yield bond.
Oh, that makes so much sense.
You shift away from seeking short-term manual labor payoffs, and you begin playing a multi-decade-long game.
It creates a compounding loop. Like high longevity justifies massive upfront investments in education. That education creates a highly skilled worker capable of doing those complex $140,000 a year financial services.
Right.
That high-value output generates immense national wealth, which the country then pumps right back into the healthcare and infrastructure systems, which pushes longevity even higher.
Exactly. It feeds itself. And the data on their educational conversion rate on slide 8 proves this loop is functioning flawlessly.
Yeah, this waffle chart visual is striking.
It is. They boast a near 100% primary school completion rate, which, is expected for a highly developed nation. But the standout metric, the part that's highlighted here, is that over 40% of their entire labor force holds advanced degrees.
That's massive.
It's huge. This isn't just the literate population, it's an elite academic cohort.
The dataset uses the Human Capital Index, the HCI, to quantify this. It shows Switzerland permanently hovering in this elite 0.76 to 0.78 range. But for you listening, what does an HCI of 0.78 actually mean in the real world? How should I visualize that?
The Human Capital Index is a really fascinating metric. An HCI of 0.78 means that a child born in Switzerland today can expect to be 78% as productive when they grow up as they theoretically could be if they enjoyed absolute perfect education and full health throughout their entire life.
Wait, so the global maximum, like the utopian ideal of human being is 1.0, and Switzerland is churning out a whole population operating at 78% of theoretical human perfection.
In terms of economic productivity, yes, it is an exceptionally high baseline on a global scale. They take that healthy, long-living population and hyper-refine their cognitive skills so they can step seamlessly into that intangible service engine we discussed earlier.
Okay, but this is the exact moment in the deep dive where the pristine FFFFFF white background starts to show a crack.
Yeah, here we go.
We've just spent all this time marveling at this flawless humming machine, this compounding loop of elite education and high-margin output. But the structural analysis of their labor market reveals a massive internal contradiction, and it's a contradiction that threatens the mathematical viability of their entire future.
It is the ultimate double-edged sword, and it sits right at the intersection of their labor force demographics and their aging population.
Let's lay out the baseline first, because if you just glance at slide 9, the surface-level labor data looks great. They have incredibly high labor force participation overall. The multi-line chart shows the unemployment rate is consistently low. And they maintain a really robust self-employment rate, floating between 14 and 16%.
People are clearly working, and there's a healthy entrepreneurial drive.
Right. But then you look at slide 10. You look at the breakdown of how people are working, specifically regarding part-time employment, and the gap is just staggering.
You're referring to the gender divide in the part-time labor data?
Yes. The structural visualization of this is striking. It's built as a dumbbell chart. And when you map out the part-time employment rates, the data shows that the part-time rate for women sits stubbornly high, generally between 48 and 54%.
But the part-time employment rate for men sits way down between 16 and 24%.
Exactly. There is a glaring, persistent gap of roughly 30%. They literally drew a connecting line between the male and female data points for each year, just to highlight how wide that gulf is.
And we need to be clear here. We have to look at this gap strictly through the lens of the macroeconomic and efficiency data presented in the analysis. From a purely mathematical, operational standpoint, this represents a severe economic inefficiency.
Right. We aren't analyzing the cultural or political debates surrounding this. We're looking at this simply as a massive spreadsheet equation.
Yeah.
And the math says this is a problem.
Exactly. Just follow the logic we just established. The Swiss model relies on investing immense resources, world-class healthcare, elite global education, generating that 0.78 human capital index into its entire population, right?
Right.
They have generated a female workforce where a massive percentage holds advanced degrees. They've built these highly capable, highly productive economic engines. Yet the data shows that a huge segment of that highly educated female workforce is structurally engaged primarily in part-time labor.
Yeah.
From a sheer return on investment standpoint, that is an enormous reservoir of potential human capital being left idle.
I think of it like building a state-of-the-art, multi-million-dollar supercomputer. Yeah. You've sourced the best parts, you've optimized the cooling, it can process complex data faster than anything else on Earth, and then you only turn it on for 3 days a week.
That's a great way to put it.
When it's running, it's brilliant. But you are leaving massive amounts of processing power on the table simply because it's powered down half the time. And why does leaving that processing power on the table matter so much right now? Why can't they just afford to be inefficient?
Because of the demographic collision course they're on. If we skip ahead slightly to the demographic data on slide 15, this is where the longevity data we praised earlier suddenly becomes a severe liability.
The aging crisis.
Exactly. The structural analysis points to a skyrocketing old age dependency ratio.
Let's define that for the listener. What exactly is the dependency ratio measuring, and what do the numbers say?
The old age dependency ratio is a mathematical comparison. It measures the number of elderly people, retirees, who are drawing from the system relative to the number of active working age people who are paying into the system.
Okay.
Historically, in Switzerland, that ratio sat comfortably around 15.5%, meaning you had a massive base of workers supporting a relatively small top tier of retirees.
Sounds sustainable.
It was. But today, That ratio has doubled. It has crossed the 30% threshold and is climbing rapidly.
Wow. So because of that amazing medical infrastructure we talked about, you have more and more retirees living happily and healthily to age 86.
Yes.
But because birth rates naturally decline in highly developed economies, you have fewer and fewer active, full-time workers generating the tax revenue to support them.
The math becomes a ticking clock. The pension systems, the specialized healthcare required for an octogenarian population, the maintenance of the public infrastructure, all of this requires maximum economic output from the working age base.
Right.
So the question is, how can a country mathematically survive a skyrocketing dependency ratio when a 30% chunk of its highly educated workforce is artificially constrained to part-time output?
The compounding loop suddenly starts working in reverse. If the working base can't generate enough surplus wealth to support the aging top, they have to raise taxes.
Which slows down the economic engine.
Exactly. Which then threatens the stability that global capital relies on. The idle human capital in that part-time gap isn't just an interesting quirk of the Swiss labor market. It's a structural vulnerability crashing head-on into demographic reality.
Which forces a very difficult strategic pivot. If the dependency ratio is climbing, and you cannot simply conjure millions of new full-time workers out of thin air to fix the math,
Yeah.
how do you sustain the $90,000 per capita GDP?
You have to multiply the output of the workers you do have. If you can't add more engines, you have to make the existing engines exponentially more efficient. You have to build economic moats.
Precisely.
And looking at the data from slides 11 through 14 on how they are future-proofing this system, the scale of their innovation is incredible.
They're essentially building fortresses of efficiency. If we examine the first major moat they've constructed on slide 11, it's built entirely out of intellectual property.
Yeah, the panel chart here tracking non-resident trademark applications is highly revealing. It shows a rapid acceleration breaking past the 50,000 mark. They literally circled the breakout point where it jumps between 40 and 70,000.
Let's break down what a non-resident trademark application actually means in the real world. Because I know that sounds like dry legal jargon, but it's actually a massive flex of global power.
Yeah, explain that.
A non-resident trademark application means a multinational corporation, maybe a tech giant in California, or an engineering firm in Tokyo, is choosing to legally park its intellectual property, its patents, its brand rights inside Swiss borders.
But why would they do that? Why not just keep the IP in their home country?
Because Switzerland offers that unshakable institutional stability we discussed earlier, combined with highly favorable and predictable corporate legal frameworks. Global capital views Switzerland as the world's most secure vault for ideas.
Okay, but how does that solve their labor problem?
Because managing a massive portfolio of global intellectual property generates billions in licensing fees, legal consulting, and administrative wealth. But it requires very few actual human beings to operate.
Oh.
Yeah. You don't need 50,000 factory workers to hold a patent. You just need a few hundred elite lawyers and financial managers.
It's the ultimate high-leverage service. But, I mean, if your entire national strategy pivots to becoming the global vault for intangible assets, patents, and digital finance, you better make sure that vault is physically impenetrable.
Exactly.
Which explains the data on slide 12, their digital infrastructure.
Yeah.
The growth curve here is almost comical. It's a parabolic explosion.
You're looking at the density of secure internet servers.
Exactly. The area chart tracks secure internet servers per million people. And it starts at a relatively modest 1,449 servers, and then the line just goes exponential, rocketing up to over
167,000.
Yeah, exactly. Over 167,000 secure internet servers per million people. They put this steep, sweeping arrow on the chart to emphasize it.
This is exponential digital infrastructure scaling. They recognize that if their future relies on exporting data and trust, they need to be the most digitally fortified plot of land on Earth.
But how does that actually manifest physically? Are they just building massive server farms in the middle of Zurich?
No, they are utilizing their geography again. Remember how the Alps used to be a physical barrier to trade?
Yeah.
Well, they've repurposed those mountains. During the Cold War, Switzerland built a massive network of subterranean military bunkers deep inside the granite of the Alps.
Okay.
Today, many of those decommissioned bunkers have been retrofitted into ultra-secure data centers.
That is incredible. So they traded physical bank vaults holding gold bars for impenetrable server farms buried under mountains holding global IP and financial data.
And it's practically brilliant. The ambient temperature deep inside a mountain is naturally cold, which massively reduces the cooling costs for the servers. They have a highly stable, independent energy grid, and they back all of this up with some of the strictest data privacy laws on the planet. The digital fortress isn't a metaphor, it's a literal geographic reality.
And speaking of their energy grid, this brings us to one of the most vital efficiency metrics in the entire analysis on slide 13. We talked about how they have to maximize output per worker, but they also have to maximize output per unit of energy.
Right.
The data set presents this fascinating concept of green decoupling. And again, for you listening, we are looking at this strictly as an impartial metric of economic and industrial efficiency, completely separate from political debates.
Absolutely. Decoupling is considered the holy grail of modern macroeconomics. For the last century, the rule of industrialization was simple. Economic growth and carbon emissions were permanently locked together.
Like a steam locomotive. If you wanted the train to go faster, you had to shovel more coal into the fire. Your emissions grew in exact lockstep with your speed.
Precisely. If a country wanted to double its GDP, it usually had to double its heavy manufacturing, burn twice as much fuel, and emit twice as much CO2. But the Swiss data proves that they have severed that link entirely.
Yeah, the visual here is an X chart.
Right. When you plot their GDP growth against their CO2 emission intensity per dollar of GDP, the lines form an X.
The GDP line continues its relentless, smooth climb upward, but the emission intensity line plummets. It drops from roughly 0.12 kilograms per dollar of GDP down to around 0.04 kilograms. They essentially figured out how to replace the coal engine on that locomotive with a magnetic reel system.
They are generating more wealth per capita while requiring drastically less physical energy and carbon intensity to do it.
And how are they doing that?
Because of the structural shift we've been discussing this whole time. Moving away from energy-intensive physical manufacturing and pivoting entirely into high-value, low physical footprint services.
I see.
Writing a reinsurance algorithm or legally processing a trademark application uses a fraction of the energy required to smelt steel or manufacture heavy machinery. This decoupling makes their economy vastly more efficient and significantly insulates them from global energy price shocks.
It's all connected. The longevity demands higher education. The education allows for advanced services. The services require massive digital infrastructure. And those digital services inherently drive down energy intensity. It's an incredibly elegant closed-loop system.
It really is.
But there is one final piece of data. The glue holding this entire futuristic, aging, highly educated digital fortress together. Without this final element, the servers are just expensive heaters, and the IP is worthless.
You are referring to slide 14, the institutional anchor, the governance metrics.
Yes. The analysis uses a radar chart to map this out, which is the perfect visual tool because it shows how a system balances across multiple different axes.
Right.
And when you plot Switzerland's data for corruption control, rule of law, and government effectiveness, the data points don't just sit in the middle.
No, they're pushed all the way out to the absolute outer boundary of the web.
Wow.
They are operating in the 99th to 100th percentile globally across these metrics.
It is mathematically maxed out. They even drew a dashed circle around the outer edge to highlight that they're permanently in the top 1% globally.
Right. And we hear phrases like rule of law thrown around all the time in political science. But in the context of this specific economic engine, rule of law isn't just a nice societal perk, it is their primary export.
It is the absolute prerequisite for their survival. You could build the most secure server farms inside the hardest granite in the Alps.
Yeah.
You can educate your population until they all have advanced degrees. You can establish the most streamlined trademark processing system. But none of that matters, literally zero, if the global community does not explicitly fundamentally trust your institutions.
Exactly. If a Japanese conglomerate thinks there is even a 1% chance a local judge could be bribed to steal their intellectual property, they won't park it there.
Right.
If an American bank thinks the government might arbitrarily seize assets during a crisis, they won't use Swiss financial services.
Exactly. That 100th percentile ranking in corruption control and rule of law is the invisible shield protecting that 41.5% trade dependency we saw earlier. It is the reason the shock absorber works. In a global economy where trust is the rarest commodity, Switzerland has industrialized and monetized reliability.
So true.
So if we pull all of this together, looking at the final logic framework diagram on slide 15, we have to step back and look at the whole picture. What does all of this actually mean?
Let's summarize it.
If we synthesize the Swiss formula we've unpacked today, On the left side of the chart, the strengths. It requires maxed-out, top-tier global governance, combined with an elite, highly educated human capital base that routinely lives to 86 years old, all of which is violently channeled into high-value-add digital, IP, and financial services.
That is the equation for incredible wealth and absolute global resilience.
Right. But on the right side of the chart, the challenge is, it is a formula facing an existential stress test.
The demographic math is ruthless. The rapidly aging population, combined with a skyrocketing dependency ratio, is colliding directly with a massive 30% gender discrepancy in full-time employment.
The idle human capital.
Right. They have an idle reservoir of elite human capital sitting right there. They have to figure out how to structurally unlock that female workforce to support the demographic shift, or the underlying math of their shock absorber economy will eventually bend and break under the weight of its own longevity.
It's a fascinating, precarious balancing act happening at the absolute summit of global economics. And it leaves me with a final thought for you, the listener, to mull over long after we sign off today.
What's that?
Well, we're moving rapidly into an increasingly digitized, dematerialized global economy. Physical borders, deep water ports, and natural resources are mattering less and less. The future is entirely about data, intellectual property, and high-level services. Will the Swiss model, this ultra-secure, highly educated, fiercely governed blueprint become the mandatory template that all developed nations must eventually adopt just to survive the next century?
Or is this 60-year run of socioeconomic perfection we just analyzed a completely localized geographic anomaly? I mean, is it the unrepeatable product of centuries of historical neutrality, highly specific alpine geography, and a cultural timing that simply cannot be copy-pasted anywhere else in the world, no matter how hard another country tries to replicate the stark data on these 15 slides?
It's a massive question about the future of how nations are built. Next time you read the economic news about your own country, think about how your national data would look stripped down to its bare essence on these slides. Would it show a smooth, engineered, upward curve of decoupled efficiency? Or would it look entirely different? Thanks for joining us on this deep dive into the numbers. We'll catch you next time.